Hi, everybody. This is George Veter Financial. Wanted to just, first of all, tell everybody that I understand this is a moment that a lot of people are nervous about in the world. And so I wanted to let you know what my thoughts are and reinforce my resolve to guide us through this one and any that we face in the future. First of all, we have two worry points in the market as we speak today, the 2nd of March. We have the Ukraine-Russia skirmish that's going on, or the invasion into the Ukraine from Russia that has been unprovoked and has disturbed the whole world with its boldness. And nobody likes to see those geopolitical aggressive movements by an aggressive country like Russia. And then we have the Fed that's meeting Congress today, or testifying before Congress today and tomorrow on interest rate policy and adjustments in the economy. So those are the two things that we have our eyeball on. And the involvement with Russia into Ukraine has made the market even more unsteady than it was, with the tentative feeling about interest rates, how far up they're going to go to combat inflation, and the worry point that the Fed might be too aggressive and stall the economy out by restricting money supply too quick. So first of all, in talking about interest rate increase cycles, the last cycle we had where interest rates went up were 2015 to 2018, the end of 2018. And we called that a normalization of interest rates, or a tightening cycle. It's important that interest rates go up so that the Fed has the ability to lower interest rates in a moment of economic weakness for a stimulative measure. And that's been the most effective tool of the Fed. But because we are essentially at zero interest rates right now, 1/4 point for the Fed overnight funds rate, so next to zero, we really don't have any room to drop rates in a scenario where we need to stimulate during economic crisis. So the Fed needs to normalize interest rates. And then the other reason interest rates need to go higher is to keep control of inflation. We are sorting through inflation right now. Exactly how much of that is long-term in nature and how much of it will subside as we get production to meet demand. Now, what do we do in order to successfully deal with inflation? Well, traditionally we buy investments that inflate with inflation, which will be equities, real estate and stocks, things that go up when the general economy goes up with inflation pressure. So you're in the right place for what's going on with this tightening cycle of interest rates. The other issue of geopolitical tension, when these things arise and we never know when they're going to, they happen from time to time. Most of that is headline risk. The world gets scared due to a threat with a foreign power. But we all have the same incentive to control that threat. The free world is much bigger than the oppressing world. And I think Russia ultimately needs to do what they need to do to compete economically in the future. And I believe sanctions will work, and the NATO nations will answer whatever they need to keep that threat under control. And at the end of the day, it'll get resolved one way or the other. We have less than 1% of the S&P companies, based on Barron's report, that have any markets in Russia or Ukraine. So it's not a big direct component to our economic activity, but it certainly is a headline risk that makes everybody a little bit nervous. In general, when we have these market corrections, they don't last long, but it always feels like the wheels are coming off the bus. My job as a financial advisor, number one, is to leverage my experience. Been in this business for 30 years, so I've been through lots and lots of these moments similar to what we're experiencing right now, and to keep a long-term perspective, right? Because all of our portfolios need to work on averages. We don't change our standard of living when we have a bad year or when we have a good year, right? We play the long game. And so that in mind, we rebalance portfolios when they get out of balance. We make sure that our managers are beating their indices. And if we have a manager or a component of our portfolio that's not doing its job, we do our research and we replace that manager with a more efficient, effective manager that's going to get us the alpha that we expect from them. And then we want to make sure that we keep our composure and don't make one of two critical mistakes when we have a moment of stress like this. One mistake is to get scared and go to the sideline when we feel pressure from whatever the event is, because typically what happens is we change our investment plan and we go to cash in a moment like this, and we feel more comfortable when the market is higher and feeling better, which means it's higher and more people are less scared and greed comes back in the market. And then we've locked in the loss because we get in at a higher value than we get out. So we don't want to make that mistake. I think the risk of that is way too great to entertain. The other risk is that we single concentrate. We feel like there's maybe a silver bullet investment, something that is going to save us from this, whether it be gold or alternative currencies or whatever people are doing to feel safer in a moment of crisis. History has told us that that's not the appropriate solve for the situation, because then you're going to an asset class that is doing better because it does better in times of crisis. And when the crisis is over, that asset class won't do as good historically. And the things that recover, we're going to be out of. And so if we bet it all on red and red doesn't work for us, we have an irrecoverable loss. So as long as we don't make those two mistakes, as long as we don't go to cash in a moment where we get scared and get in at a higher level or get back at a higher level, and if we don't single concentrate or look or believe in the silver bullet effect where we put too much in one area and we don't keep properly diversified, and then we stay steady through these things and we play our averages, then these moments of panic really don't have any long-term bearing on our success as investors. So if you feel nervous or you feel like you need your nerves to be calmed, we're completely accessible. Beyond doing our reviews for you on a quarterly basis, we're here every day answering phone calls. We love it when you communicate with us. We don't want you sitting home worrying about a headline. We want you to know our take on it, and we want you to have confidence in our leadership through it. So in this moment, I want you to know that we will work through these couple of worry spots in the market, and we will resume the prosperity growth of free markets, and we're well placed and well diversified and have a proper plan to take advantage of that. In the meantime, just know that we have you, we think of you, we worry that you're worried when you're worried, and we want to do whatever we can to calm your nerves. And anyway, God bless you. I can't wait for our next review.